Guys, these are 3 of the 13 companies I own. I want to show you my thought process along the way. I want you to keep in mind, I try to keep my decisions very simple. Fundamentally, it's based on 3 questions. First question, do I think this company is going to be around for the foreseeable future, 10, 20, 30 years from now? If the answer is no, I move on. Because my goal for myself is to buy companies that I can buy, not think about for a long time. If the answer is yes, I go to my next question. Do I think the revenue and profit will be higher 10, 20, 30 years from now than it is today? Very simple question. And by the way, some companies may not have that. I don't know which ones, but there are companies out there you can sit there and say, I think there's some problems here, or there's going to be a lot more competition, or they rode a wave, etc. And if the answer to that is yes, I go to my third and final and most important question. Can I pay a reasonable price today based on that future outcome that I expect that gives me an adequate return on my money? What's an adequate return on my money? Well, you can get 9% by investing in a low-cost ETF. So for me, I sit there and say, I probably need to get above that return. Some sort of margin of safety there to allow for 2 reasons. 1, we don't know the future, and we're human, make mistakes. And 2, I also feel like if I'm going to buy an individual company, I need to buy it when I have some reason above the market return of 9 or 10% to buy it. Now, this might sound overly simplistic. Good. I have found that in investing, it's one of the few, actually most areas of life, but even more so in investing, the simpler I keep it, the better I will do. That's it. An example I have here that just occurred. Starbucks just reported, and they missed slightly on revenue and profit, but they had a bad outlook. They're down 17%. So I went on Twitter and I posted, is Starbucks a buy, hold, or sell? 47% said buy. The vast majority said hold or sell. I'm quite sure if I had asked this before Starbucks earnings had come out and the stock had fallen 17%, it would have been a little bit different. There probably would have been more on the buy side because, it's a great brand, all these things. To me, I like to get rid of the noise and the short-term news problems because I look at Starbucks saying, yes, there's more competition for Starbucks and they still win. And if I asked 100 people, hey, can you get rid of your Starbucks addiction who are addicted to Starbucks? They'd be like, yeah, I can't do that. Or if I asked 100 people, what's the number 1 coffee company? Probably 100 of them are going to say Starbucks. I don't mean that that's their favorite. I mean the number 1. So that's my kind of thought process when I look at this. So what's my next step? Well, first off, let's pick one of the 3 companies, Generac. Now, I'm hoping you're sitting there going like, who the heck is Generac? Boom. Already love it. I like to buy companies that seem to be a little boring. Generac makes generators, okay? So I pull up Generac, and one of the first things I liked about it was this. All-time high of $524 back on November 2nd, 2021, and it's currently trading for about $130. Now, just because the stock is down that much, 85, 80, whatever it is, 70%, that does not make it a good value. I repeat, just because the stock is down 60, 70, 80% does not make it a good value. It's a great place to start, though, to look for that. Has the sentiment shifted on Generac? Well, if you remember, this lead up right here was because of COVID, and people started putting a lot of money into their houses, and people were really enamored with home improvement businesses. Now, I sit there and say, okay, this is interesting, already interesting. What's the reason I'd like Generac? Well, okay, I did some thinking. All right, global warming is getting worse, okay? The number of storms that are occurring in this country are far greater than they were 40, 50 years ago. Storms lead to power outages. People don't like power outages. They use generators. Great. This is just a story. Remember, as Professor Aswas so eloquently says, a story without numbers is a fairy tale. Numbers without stories is an Excel sheet. I'm trying to marry the two. I can have a great story, but if I don't have the numbers that justify the investment, it does not matter. What you'll find out there is people will say, generator is a great business. These people are the leaders, buy them. Well, that's the truth here and here. So to me, that's not an investment. That's a speculation play. If I change the price and the story is exactly the same, I'm not investing, I'm speculating. I'm hoping for the future. I need to make sure that my decision changes based on here versus here. That's the big key, okay? Now, next thing I look at is, what's the market for generators? Is it a growing market? Is it not a growing market? Well, I did some research on that. And I found that in 2030, The generator business is supposed to be about $9 billion a year, and currently it's about $6 billion. So about a 50% growth rate. Not a ton, but you're going to have an increase in costs. You're going to have an increase in sales, plus overall the market's going to grow. All right, not bad. So Generac, being one of the top generator companies in the world, in the US especially, will probably ride that coattail. But I think you're going to see a lot more people doing generators for their homes. Okay, so that story seems to line up. The question is now the numbers. Let's pull up some information on Generac. Okay, so here's some overview on Generac. 80% domestic, 20% international. That's one part I love. Because the US market's going to get stronger and they can grow internationally. They have a great, what's called omni-channel sales. Thousands of dealers, wholesalers, retailers. If you go to Generac's website, type it in, they're going to put you in touch with a local retailer who can install it for you and doing all of that. 8,600 employees worldwide, fine, doesn't really matter to me. EBITDA of 638, fine. It's a good metric to know when looking at valuation. Sales of $4 billion in 2023. Okay, that's a lot. Breakdown, 51% residential, 37% commercial, industrial, 12% other. All right, so this is a kind of an overview saying, all right, the things that I love the most are, this stat right here shows a lot of international potential growth, and I love how they sell. They have their dealers are incentivized, they use Generac, etc. So these are some positives we have going there. That's very simple. I immediately now skip to one thing, two things actually. One, they're 8 pillars. Now, the 8 pillars are here to tell a story. I never make a decision on the 8 pillars. I have ignored 8 green check marks. I have bought when there's a majority or all red X's. It's all about the story it tells. So let's look at Generac here. Okay, interesting. Net income is down. Free cash flow is up over the last 5 years. All right, not bad. The debt level, I'm kind of wondering about that one. Why is the debt like this? I really don't know. Another little area of concern for me, 5-year free cash flow is 267, 5-year net income is 340. I don't like that difference there. I don't like that difference, but let's see if it's a short, but I do like the fact that their free cash flow is higher than it was today by $150 million versus a drop of $48 million. So $200 million swing to free cash flow relative to net income. Good ROIC. They get a good return on their money invested in the business. And they haven't bought back many shares. So revenue growth. So all these things right here is telling me I'm not wowed and I'm not turned off. I'm just like, okay, let's see. Let's immediately skip then to my most important part. And that's my stock analyzer tool. Now, here is why the stock analyzer tool is extremely important in my process. Guys, I cannot repeat this enough. A couple years ago, we got in a little YouTube battle with somebody who was defending Tattooed Chef. And his comment was, you got to understand the business top to bottom before you look at the numbers. 100% wrong. It's an opinion. Yes, it is an opinion. But I've never met a good investor who wastes their time absorbing the story. They want to see some sort of question of, is it even the realm of possibility? And the reason being is, why waste your time? If you make every great assumption in the world, the number one line here is revenue growth. If you make the greatest revenue growth assumptions in the world on this company, and it still comes out overpriced, why waste your time going further? Set it on your watch list, and then when it gets to the price that you want to start taking a look at it, that's what you do. There are too many companies out there to look at. Do not fall in love with the company. Do not fall in love with the story. I want the price relative to value to drive your, okay, if it's, let's say, for example, hypothetically, Generac is selling at $130 a share, and our stock analyzer tool pops up and says, this thing is worth $500 a share. You better do some research there. But if stock analyzer tool says it's worth $20 a share, why are you wasting your time? Why? You're wasting your time when you could be looking at better companies that fit your criteria right now. So let's go pull up the last time I did Generac in my history. Now, guys, the great thing about our stock analyzer tool, I can do between 1 and 20 years of analysis. I've done 20 years before. I've done 5 years before. I like to stick with 10 for me. So, of course, it preloads 10. But if you're looking at it as a turnaround play, some sort of short-term investment, 5 or 3 years might be appropriate for you. If you want to own it forever, maybe 20 years is appropriate for you. It's really what makes sense to you. But the point is, I highly encourage you very quickly in your research to decide, is it even within the realm of possibility? So here are the assumptions I made for Generac going for the next 10 years. 4, 6, and 8% revenue growth. And as you can see, guys, I did low, middle, and high. And the reason being is investing valuation is an imprecise art. You're going to have a wide range. We don't know what the future holds. If we knew what the future held, we would just sit there and say, okay, what's the stock price going to be? But we have to have a range of outcomes here. Could it be better? Could it be worse? Could it crush? There's all these things that have to be questioned. Remember, the stock was selling for $520 just a few years ago. Obviously, the assumptions made about the future were far more egregious than should have been made. So we have to have a wide range. Profit margin. I look at the history. Seems like it's pretty consistent between 9 and 10%. So I did 9.5, 10.5, 11.5. Free cash flow seemed to be right around the same, maybe a little bit lower. So I put 9.5, 10.5, and 11.5. And keep in mind, guys, free cash flow last year was much greater than net income. Okay. PE. This is the question. What's the appropriate PE for a company like GNRC? This is the art of investing. Everybody's going to have their own opinion, but I think it's a top quality company that's a leader in its industry. That deserves a premium. The market average should be 15 over long periods of time. I put that as my low side. I put 15, 18, and 21. And this will change depending on the company you're looking at. If you're looking at a retail company that has stores, you might put a lower multiple because retail is changing. If you're looking at a tech company with a really high return on invested capital and a really fast growth rate, you might put a higher PE. It's all part of the process for you to understand. And this is what I'm trying to teach on this channel. There are fundamentals and there are emotion, but it's combining those two. And it's about sticking to what you believe in on the fundamentals. At some point, a stock you love is going to fall hard. The question is, are you going to have the ability to sit there and see that stock fall hard? And instead of worrying and panicking and sitting there and worrying if your money's going to zero, can you make a grounded decision going forward? That's what's going on with Starbucks right now. It's down 17%. I own some shares. Again, don't buy it just because somebody on the internet says to. Do your own research. But it's 17% drop. I look at going, what happened in the last day since they reported that justified a 17% drop? Is it a long-term trend? Is Starbucks going to start failing from here? Of course, there are people out there going to believe it. The question is it true? That's what you have to assess. Now, the final line is desired annual return. Guys, for the videos, I put in 9%. Just for the market, it's basically my intrinsic value. If I were to invest in this and wanted to meet the market returns, I might want to put 9.5% in here, whatever it is, I put 9%. Now, remember, you need to put margin of safety. How do you put margin of safety in? You increase that return. The higher the return, the lower the price you're going to pay because you need to pay a lower price to get a higher return, right? So for here, again, there's no margin of safety in this number. So I hit the analyze button. All right. I've got 103 on the low side, 209 on the high side, 148 in the middle. It's at 127. The middle price, assume if it's about 11% return, buying it at today's price. So I look at it going, okay, that deserves more attention. And from there, I might go in there and research a little bit more. But honestly, guys, I'm buying bigger companies. The companies I'm buying are probably going to be around for a long time. On the smaller companies that people buy, you really have to dig through the details. I'm a lazy investor. I want to pick bigger companies that have a lot more potential. Guys, GNRC was selling for $80 a share recently. It would have been green all the way around. So guys, you saw a company like GNRC go from 525 down to 80, back up to 130, 140, 150 very quickly. This is an emotional roller coaster. And you're not the only one that feels that. I don't care if you bought GNRC at 520, 400, 300, does that. Even if you bought it at 80, seeing it go to 150 and then pull back, it's still going to cause some issues. And that's the most important part about investing, is understand that emotional part. You're going to use the fundamentals to buy a company, but it's the combination of fundamentals, but more importantly, the emotion of staying in tune, because every stock you own at some point will have bad years. It absolutely will. Sentiment will change. And you'll be sitting there saying, what am I missing? Because the news will be out saying, this company sucks. No, they're reacting usually to the stock price. Once I learned that the emotion is 90% of investing, that's what I focused on. And I started to realize, I started to put things in place for myself to handle my emotions better. Now, will that lead to better results? Absolutely. But more importantly, it'll lead to me sleeping better at night and making less and less emotional decisions that will cost me money down the road. That's what's so important. When you see a stock fall, you feel stress, anxiety. I feel it in my stomach and I just feel uneasy, and you want to make that pain go away. So what easier way to make the pain go away than having a community of like-minded investors, thousands of people here you can talk to, and they can talk to you to help teach you what they've done. Learning the emotions of investing is the most important thing that you need to focus on. The numbers are easier. It's about sitting there and saying, is this correct? Is the stock falling for the right reasons or the wrong reasons? And being able to make decisions from there. Because guys, we always talk about it. Whenever you look at a stock price fall, in hindsight, when it's gone up 10 times, you sit there and go, man, I should have bought there. But that's in hindsight. You want to be there in the moment saying, this is the right time to buy. So if this makes sense to you and you want to control your emotions better and have all the tools to make better decisions, click the link below, $7 for 7 days. Guys, we limit the number of spots every day. If you don't get in, they sell out pretty early. You'll be on a wait list. Now, there are ways to get ahead of the wait list, but just save yourself the time. It's only $7. Go click the link, sign up now. Stock number 2, Southwest Airlines. Now, Guy, I'm going to go through this a little bit faster because we've already covered this, but let's pull up Southwest in our numbers. Now, I'm going to go right to the 8 pillars. Look at how terrible this looks. 7 X's, 1 check mark. I'm going to be interested going, here's the story. How is revenue up 5.2 billion? Net income is down 1.4, free cash flow is down 2, and the valuation metrics are insane. That to me is like, okay, what am I missing here? What's going on? So I look at Southwest and I look at it and think to myself, well, wait a second. The 5-year profit margin is 0.6% and the 1 year is 1.5. That's weird because I want to go look at the data going, I remember Southwest making a lot more money. Going back to 2014, I put this in a easier chart for you guys to read. Going back to 2011, revenue on the top line, on the second line, gross profit and net income. 1.1% net income, 2.5, 4.3, 6.1, 11, 11, 16, 11, 10. Then COVID hit. So I'm looking at this saying, okay, the 5 previous years, it was between 10.5 and 15%, mostly at 10 or 11%. So there's a cost issue. Well, what's the reason? Guys, Boeing, that's a big reason. They have all Boeing planes, and Boeing's going through some crap right now. I gotta think that's hurting things. Then I look at gross margin. How much money they make on every extra dollar sold? It's at 16% right now. Before COVID, 27, 27, 30, 31, 32, 24 and a half, 20. So apart from one, I'm looking at this going, their gross profit is clearly lower than it should be. All right, we're getting somewhere. That's great. Now, why do I love Southwest? Let me show you a few more things. These are the number of passengers carried by the top airlines. Southwest number 4 at 126 million passengers. American was almost 200 million, 144 for United, 141 for Delta. But here's the interesting part. These are the number of cities each of these airlines flies to. So Southwest at 126 million passengers, only flying to 131 cities. These other ones, 350, 356, 313 cities. And they didn't even, I think American crushed. I'm looking at this going, all right, these guys own this market. And the other thing is they're only in the US and like Central America, Mexico, Caribbean, et cetera. And I'm like, okay, so they're an efficient airline. The other stat I know about Southwest is before COVID, I think they were profitable 54 years in a row or something crazy. They do a great job hedging their fuel costs. They're a great operator of airlines. They keep short routes and they keep the exact same plane so they can be efficient with their maintenance. But not everything's rosy. This is from their 10K. This is looking at their percent change. Good. They had 10.9% increase in their revenue. That's great. Yeah, here's the bad news. Salaries, wages, and benefits up 18.6%. Fuel down 1%. Maintenance up 50%. Overall costs up 12.2% relative to revenue up 10.9%. Whenever costs increase so much, though, I look at it going, that's short term. This is going to get passed on to consumers at some point. The question is, are they a well-run airline? And pre-COVID has proved that. Is the world after COVID different? Yeah, maybe. But I look at Southwest saying, no, they're adapting. There's even talk of them changing their whole entire boarding process of having people randomly select seats. Something else I loved. Short routes, here is their index of favorability scores. Highest one. JetBlue, Alaska, Delta. And by the way, I've flown JetBlue, I've flown Alaska, I've flown all of these. I don't think I've flown WestJet, American Airlines, Air Canada, Spirit. I'm actually surprised Spirit's above United because I like United more. But either way, I look at that saying, okay, this is a quality airline. People like Southwest. The flight attendants are very funny. They make jokes. It's a great experience. So then I sit there and say, okay, it's time for stock analyzer tool. Why? Because I got to see how is this company going to do when profit is normalized. So I pull up Southwest. Remember, this last year, they did record revenue, but profit was crap. I should go 8, 10, and 12. Or I do 8, 10, and 13. I'm going to go a little bit higher than the normal. I'm putting a premium on them because they're a great airline, a great well-run airline. And my 9% return, I look at this saying, okay, the stock's at 25, low price of 53, high price of 143, middle price of 85. Guys, I don't know if Southwest is going to work out or not. But if I can have 30 companies with these metrics that lead to these returns, I'm probably going to do pretty well. That's what I like to do. I want to have a diversified group of companies, 20, 30, 40 companies that all are priced below their value. I'm not going to be right on all of them. In fact, I will kill it if I'm right on 60% of them. I don't have to be right on every single one of them. I just have to be not very wrong on them. Southwest, 25.67. I bought it for 25 the first time ever in the pits of COVID. And it flew to 50. I sold it at 48 or 49, went to like 65 or something absurd, and it's just fallen back down. Is it temporary or is it permanent? That's the question. Third stock, Sprouts Farmers Market. Now, guys, I found Sprouts Farmers Market from going on a trip. The funny part was I was upset they didn't have Coke products because they're organic, healthier store, etc. But I was really amazed by how busy the store was and how small the store was. And people loved it. I was just like, okay, there might be something here. So I took a deeper look. Now, some things that I liked a lot. First off, number of stores by state. California, 130, Texas, 51, Arizona, that's where I was when I saw it, 44. But look how many states have less than 10. The vast majority. So what does that tell me? Long runway. 2, they have over double the profit margin versus other stores. Like Kroger has like 1.5%, 2%. Sprouts Farmers Market, 4%. Awesome. Country's becoming more organic, more healthy. This will help Sprouts Farmers Market. They had great chips. I kept buying their chips at the store. I do remember that. Another thing, I was sitting there and looking at it going, okay, the store is small. Kroger's store is about 150,000 square feet each. Sprouts Farmers Market, the average store size is 28,224. And it's pretty much been at that level for quite a few years. And this is based on 2022 data. So I'm looking at going, they're all about being efficient. Southwest, all about being efficient. I love the efficiency part, especially in a tight margin business like grocery. Now, whenever it comes to retail, you've got to focus on comparable store sales. What that is, it takes the store sales on stores that have been open for a longer period of time, 12 or 18 months. Sprouts, in their 10K, says it takes about 4 years for a new location to become pretty mature, okay? But look at this. Comparable store sales growth, 2022 was 2.2%, 2023, 3.4%. How many stores do they have? They started 2022 with 374. They opened 16, closed 4, ended with 386. 2023, 386, opened 30, closed 11, and acquired 2 for 407. So I'm looking at this going, okay, they have some runway. That's not a lot of stores. When during digging deeper, their goal is to have 1,300 to 1,500 stores. So they still have a lot of growth potential here, at least 3 times growth potential. Now, just because they grow a lot doesn't mean they're going to do it well. A lot of publicly traded companies have a problem with doing that. They get very tied up in that. We got to grow, we got to show them more revenue. I want them to grow smart. That's very important. They just brought on the CEO. He came from the dollar store, Dollar Tree, and he's all about maximizing per square foot revenue. For the record, their per square foot revenue is about $600 per square foot. Kroger is like $850. So they're definitely trailing Kroger here. But they're hitting a niche with a much higher gross margin than Kroger has, and that's important. So let me get into that a little bit more. Sprouts Farmers Market, their gross margin is 37%. That's really high. That's like Big Lots margins. That's way higher than Walmart. 37% for a grocer. Gross profit margin, by the way, is every extra dollar to sell. It's basically their cost, their profit after taking out direct costs to sell the item. Look at Kroger, 22%. 38 versus 22. Their bottom line margin, 1.5% versus 3.9% by Sprouts Farmers Market. So it hits those boxes. Now, guys, in full disclosure, I bought Sprouts Farmers Market when it was at 32 to 35. It's now at 65. So is this still a good price? Well, let's pull up a stock analyzer tool and see what it says. Now, obviously I already own it, so it's a little bit more biased, but I sat here and did very conservative revenue growth numbers, profit margin, etc. And I want you to take a look at this. But my 9% desired return, guys, it's pretty much all red now. So even though I love the company, there's a price that's too high for me, and $65 seems too high for me. I could be wrong. If they hit all their numbers here, but it's still only 9%. Doesn't give me much margin of safety. So guys, this is how I look at stocks. This is how I bought these 3 stocks. Guys, don't forget, join the community so you can use these tools to make your investing better, but more importantly, to handle your emotions with the community and get better returns in the long run. Take care.